Some ways of investing are wealth traps, others are proven paths to millions, and only a rare few are how billionaires scale money at a global scale. So, let's break it down from the absolute worst to the very best ways to invest your hard-earned cash. Speculation attracts beginners who want quick wins and don't want to wait years for compounding to work. It looks smart with all of those charts and brokers, but underneath it is basically gambling. People fall into this tier because they want money fast, but fast money almost always leaves even faster. So here's the simplest way to see it. Okay, imagine you've got $1,000. A broker says, "Don't worry, I'll lend you 20 times that amount." You can place bets as if you had 20,000. Well, if the asset you bet on goes up 1%, your $20,000 position grows by $200. That's a 20% profit on your $1,000 instantly. Feels incredible. But if it goes down 1%, you lose $200. That's 20% gone. If it falls 5%, your entire $1,000 is wiped out. Zero. That's how CFDs or contracts for difference work. You never actually own the stock or the currency. You're just guessing whether the price will go up or down. It feels like you're investing, but it's really betting with borrowed money. The regulators know how bad it is. Okay. In Europe, ESMA forces CFD brokers to post a warning on their websites. 74% to 89% of retail investor accounts lose money trading CFDs. Academic studies back this up. Okay. Research by Barber, Lee, Liu, and Odin showed that over 80% of day traders lose money and only a tiny group make profits consistently. And even outside of CFDs, speculation hides in products like high-fee manual funds. The bottom line is, speculation investing is designed for newbies who think they might be one of the lucky ones. It exploits the naive of people desperate for quick wins, and that is why it sits firmly in F tier. Now on to D tier, momentum investing. So D tier is what happens when people confuse hype for strategy. Momentum chasing means buying whatever is hot, whether it's meme stocks, a sector bubble, or flipping houses in overheated markets. The logic is simple. It went up yesterday, so it'll keep going up tomorrow. Momentum chasing attracts people who don't want to be left out. It's fully fueled by FOMO. You see a coworker double their money on a stock, so you buy in. You watch houses selling for ridiculous markups, so you borrow to flip one yourself. It feels smart because everyone around you is making money. But this logic is broken, okay? It's the same as saying if a baby doubled in weight in their first year, they'll weigh 7 tons by the time they finish high school. Growth curves don't work like that. What shoots up fast eventually slows, stalls, or reverses. Take real estate, okay? During hot markets, flippers make quick fortunes. But when the market cooled off in 2025, margins collapsed. Atom data shows that flipping profits fell to a 17-year low, averaging under 25% before expenses. So, by the time you pay for renovations, taxes, and realtor fees, many flippers are barely breaking even, or even worse, they're losing money. And stocks tell the same story. In every bubble, dots in the early 2000s, meme stocks in 2021, AI darlings today, the early players win big. But most people only hear about it once the headlines hit. That's usually the top. By the time they buy in, the insiders are already cashing out. That's why momentum chasing sits in D tier. I mean, at least here, you own something, unlike F tier, where you own nothing at all. But you're not investing based on fundamentals. You're just betting that line will keep climbing forever.